ready to dive into something maybe a little unexpected. Um, Inflation and compound interest. I know. It doesn't exactly scream fun times, but stick with me.
It's really more about understanding how money works, the forces that shape all of our financial lives.
Exactly. And we're going to break it down, make it relatable, and maybe even, dare I say, fascinating. We're talking about the real-world impact on your wallet, how to make savvy decisions, and maybe even unlock some financial superpowers along the way. What do you say?
Think of it like a crash course in making inflation work for you, not against you.
I like that. Okay, so quick question for you out there listening. Have you ever thought about how much the price of things has changed? I mean, I remember when a candy bar was like a quarter.
Mm.
These days, well, you tell me. What's something you remember being way cheaper way back when? Anyway, that's inflation in action.
It's that sneaky feeling that your dollar it doesn't go as far as it used to,
Right.
right?
It really doesn't.
Our source actually uses the example of a loaf of bread. Back in 2000, it was $1. Now, $3. And that's not just, about bread getting more expensive. It's the value of our money decreasing.
And it's not just like candy bars and bread. Inflation, it impacts everything. Wages, rent, even interest rates.
Yeah.
It's a ripple effect, through the whole economy.
It's fascinating. When we say inflation, we're really talking about purchasing power. How much can your money actually buy? And, in really extreme cases like Zimbabwe or Venezuela, we've seen what's called hyperinflation just wipe out people's savings, cripple entire economies.
Yeah, it's a stark reminder of why understanding inflation is so important. But okay, let's move on to something a bit more inspiring, shall we? What's often called the eighth wonder of the world,
Oh, I know this one.
compound interest.
Yeah, compound interest. It's often misunderstood, but so powerful once you really grasp it.
We're not just talking about earning interest on your initial investment, but on the accumulated interest too.
Yeah,
It's like a snowball, right? Picking up momentum as it rolls.
like a snowball rolling downhill. Starts small, but picks up more and more snow, grows exponentially.
Exactly. Let's make this concrete, all right? Let's say you invest $10,000 with an average return of 7%.
Yeah.
After a year, you'd have $10,700. Not bad. But here's the magic. Year two, you're not just earning interest on that original $10,000, but on the $10,700.
And it keeps going, compounding year after year. After 10 years, you'd be close to $20,000. After 20, almost $40,000.
Whoa. Think about that for a second. Almost $40,000, and you didn't even have to add another dime to that initial investment. Just let compound interest do its thing.
Now, I know investing, the word itself can sound kind of intimidating, especially compared to just keeping your money safe in a savings account. But that's where things get really interesting.
Hope that example we were just talking about, the whole $10,000 investment thing, got you thinking, about the possibilities.
It really shows how even small amounts, given time, can really grow. But I bet some people are out there thinking, investing sounds great and all, but isn't it, risky compared to just keeping my money in a savings account? It's a common concern, for sure. And it's a good point to bring up the whole saving versus investing debate.
Right, the classic dilemma. Okay, so let's say you've got, I don't know, $10,000
Yeah.
sitting there. What do you do with it?
Tough choices.
On the one hand, you've got the savings account, maybe earning you, like 0.5% interest? Seems safe, predictable. But hold on. Remember inflation, that sneaky thing we talked about. If inflation is, say, 2%, your money's losing buying power, even while it's earning that tiny bit of interest.
Yeah, after 20 years, that $10,000 would only be a little over $11,000. And here's the thing. That $11,000 won't buy you nearly as much as it could have 20 years ago because of inflation. It's like, I don't know, running on a treadmill.
Yeah.
Putting in the effort, but not really getting ahead.
Good analogy. Okay, but now let's look at investing that $10,000. If you put it in the stock market with an average return of, let's say, 7%, after 20 years, you'd have almost $40,000. Even after you factor in that 2% inflation, you're still looking at a real return of around 5% each year.
Investing, though, it does come with risks, right? And the stock market, well, it can be volatile, but over the long term, history shows it tends to outperform savings accounts by a lot.
So hold on, are we saying ditch the savings account entirely? Throw all our money into the stock market? Maybe not the wisest move, right?
Exactly. It's about finding a good balance, what works for you, your goals, how much risk you're comfortable with, all that.
Okay, that makes sense. But how do we even figure out that balance? Where do we start?
It starts with understanding what you're saving for and when you need the money. Short-term goals, like if you're saving for a down payment on a house in a couple years, might be better off in a savings account. or a high-yield savings account. That way your money is easy to get to, relatively safe.
But for those long-term goals, like retirement, where you have more time to, you know, ride out the ups and downs of the market, investing starts to become a bigger part of the picture.
And even within investing, there are different types, right? Stocks, bonds, real estate, they all have different levels of risk, different potential returns. It's not a one-size-fits-all thing.
And that's where it can start to feel overwhelming, right? Like,
Yeah.
how do we navigate all these choices? Figure out what's right for us.
That's where having a financial plan can be a lifesaver. Doesn't have to be super complicated. It's more about setting clear goals, figuring out your risk tolerance, and then choosing the right mix of saving and investing strategies to actually reach those goals.
So it's not just about how much money you make. It's about making smart choices about how that money's working for you.
Exactly. And one of the most powerful strategies, something we talked about earlier, is the power of consistent contributions. Remember that example. Adding just $100 a month to that $10,000 investment.
Yeah, ended up being a difference of, what, tens of thousands of dollars over time?
That's compound interest for you. Rewards consistency. Even if you're starting small. Small, regular contributions, consistently invested, can lead to surprisingly big returns.
Like the tortoise and the hare, right? Slow and steady wins the race. But how do we actually stay consistent? Life happens, unexpected expenses, motivation can fade. It's tough.
One of the best ways is to just automate it, your savings, your investments, set up automatic transfers from your checking account every month. You don't even have to think about it. You'll be surprised how quickly those little amounts can add up, especially with compound interest working its magic.
Takes the willpower out of the equation, right? Makes it almost effortless. Speaking of effortless, any effortless ways to combat inflation? Because it feels like no matter what you do, prices just keep going up and up.
Well, there's no, magic bullet to completely avoid it, but there are some things you can do.
Ooh, give me the secrets.
Well, one way is to invest in assets that have historically done better than inflation, like stocks or real estate. We already talked about stocks, but real estate can be a good hedge too, because as the cost of living rises, property values tend to go up as well.
Makes sense. So our homes aren't just a place to live, but also a potential asset to help us, stay ahead of inflation.
Exactly. But, real estate investing, it's got its own complexities. It's not as passive as investing in stocks. It requires research, being careful, and maybe ongoing management. It's not for everyone.
Gotcha. So for those of us not ready to be landlords, any other options
Yeah.
to protect our money from being slowly eaten away by inflation?
Definitely. There are investments specifically designed to combat inflation, like Treasury Inflation Protected Securities, TPS for short.
Okay, TPS, I'm listening.
So they're basically government bonds that adjust their value based on inflation. If inflation goes up, the value of your TPS investment goes up too.
So they keep pace with inflation, basically, help you maintain your purchasing power.
Right. And then there are I bonds. They offer a combo of a fixed interest rate and an inflation-adjusted rate, so a bit more flexibility.
So like a whole world of options out there, each with their own, pros and cons. How do we even begin to sort through it all and figure out what fits us best?
Well, that's where doing your research, understanding what each investment really means becomes important. And, if it feels overwhelming, don't hesitate to talk to a financial advisor. They can help you make a plan that works for you.
A financial advisor is like a personal trainer, but for your money, right? Helps you make better decisions and reach your goals.
Exactly. Someone in your corner who gets your situation and can guide you on the right path.
I think the big takeaway for me is we don't have to be financial wizards to make good choices with our money.
Totally agree. It's more about understanding the basics, knowing what's going on, and then making choices that work for you.
All right, so we covered a lot. Inflation, compound interest, saving versus investing, even some strategies for dealing with inflation. A lot to take in.
Yeah, take some time to think about it all and how it might fit into your own, financial journey.
So as we wrap up this deep dive, what are the key takeaways you want our listeners to walk away with?
For me, the most important thing is knowledge is power when it comes to your money. Understanding these core concepts, inflation and compound interest, it's like having a map. It helps you make better decisions, avoid those common mistakes.
Yeah, it's like being able to see the financial landscape more clearly, right?
Yeah.
Anticipate the challenges, make choices that set you up for success.
Exactly. And remember, you don't have to be like a financial guru to make smart choices. Start with setting some goals. They can be small. Do you want to build an emergency fund? Save for a down payment. Start investing for retirement. Once you have those goals, it's easier to make a plan and, well, take action.
And that's where consistency comes in, right?
Yeah.
Even those small, regular contributions, whether it's to a savings account or an investment portfolio, it all adds up over time,
Hmm.
especially with compound interest working its magic.
It really is. It's like planting a seed. You got to nurture it over time. Might start small, but with consistent care, it can grow into something strong, fruitful.
Love that. It shows how important patience and discipline are when you're trying to build wealth. It's not about, getting rich quick. It's about those smart choices made consistently over time.
And don't let fear stop you. The world of finance can seem confusing, but there's help out there.
Totally. We've included some helpful links in the episode description, things like articles, calculators, even some book recommendations, to keep learning. And there are always financial advisors who can offer more personalized advice and support.
So, as we close out our deep dive, I want to leave you with one final thought. Think about your own aspirations, your dreams, goals. What can you do today, even something small, to start moving towards them?
Remember, financial well-being, it's not just about the numbers in your account. It's about having that freedom, peace of mind to live the life you want.
Keep learning, keep exploring, and remember that financial roadmap we talked about. It'll help you navigate your journey.
And remember, even small steps can make a big difference over time. Until next time, stay curious and keep diving deep.